Real estate and purchasing short-term rentals has the highest leverage on not just the cash flow, finding deals where sellers are going to be willing to do seller finance, which I was telling you about earlier. The true highest leverage thing here is the bonus depreciation that you're able to take when buying a short-term rental, okay? This is why long-term rentals and multifamily literally does not work. Unless you're a full-time real estate professional, and these rules don't apply. But you can't accelerate depreciation on those homes. Why is that? The IRS, when they look at what's called a paper loss, but I'm not going to get into it, you can only depreciate against active income with other active income activities. So for example, if you buy a long-term rental, is that an active or a passive activity, and why? Because you're doing nothing, according to the IRS, right? It's zero. You get one tenant, you have one property manager, and he spends literally less than 25 hours a year doing anything for that business. So when they look at you buying a long-term rental, they recognize there's almost no depreciation that you can take. It's amortized over this like 27.5 year period. It's like almost negligible. Like for you, literally negligible every single year. But with short-term rentals, it's completely different. If you run that property as a business, which a short-term rental classifies as that, which you obviously would, especially if you're working with us, everything we do is short-term rentals. You can accelerate typically 25 to 35% of the total purchase price in that year one.